Warren Buffett, the legendary investor, has a fascinating story that starts in his childhood. Imagine a young boy, not even a teenager yet, trying his hand at investing. He didn't quite hit the jackpot at the age of 11, but it took his first step into the world of stocks. And little did he know it would become his life's passion. Warren shares that he started experimenting with investments when he was just 11 years old. However, he admits to not diving headfirst into investing until he was around 11 or 12. It's a bit unfortunate that he didn't start even earlier. But that's the beauty of his story. Investment doesn't have an age limit. His journey began with the purchase of his very first stock at the tender age of 11. Excited, he dabbled in various investment strategies, including timing the market and intricate chart analysis. He describes these early attempts as profitless but a lot of fun. You see, even the Oracle of Omaha had a share of trials and tribulations before he reached the pinnacle of success. For nearly a decade, from ages 11 to 19, Warren Buffett immersed himself in the world of investing. He devoured books on the subject from his local public library, and he couldn't get enough of them. The world of investing fascinated him, but he was missing a crucial piece of the puzzle: a solid framework. During this early period, he didn't have a structured approach to investing. He was searching for answers, hoping that the patterns he saw on stock charts would reveal the secrets of successful investing. It sounds a bit crazy in hindsight, but Buffett was simply going with the flow, doing what everyone else seemed to be doing at that time. It wasn't until 1949, when he was around 19 years old, that everything changed. He stumbled upon a book that would become his investing Bible, The Intelligent Investor by Benjamin Graham. Before that moment, he hadn't even heard of Benjamin Graham. But those two fateful chapters in Graham's book would set the philosophical foundation for Buffett's entire investing career. Graham's teachings, although seemingly simple, were revolutionary for the young Buffett. He absorbed them like a sponge, and these principles would go on to shape his approach to investing in three fundamental ways. Now, let's discuss the three pillars of Buffett's investing philosophy. Number 1. A stock is part of a business. Graham's first lesson was that a stock is not some abstract, isolated entity. Instead, it's a part of a larger business. To value a stock, you must first evaluate the underlying business. Consider its economic characteristics, its competition, and the quality of its management. In essence, think of it as owning a slice of a company rather than just a ticker symbol. Buffett reminisces about his early days, when he knew all the ticker symbols on the New York Stock Exchange, but had no idea about the businesses behind them. That had to change, and it did, thanks to Graham's wisdom. Number 2. Mr. Market's Daily Mood Swings. Graham's book introduced Buffett to the concept of Mr. Market. Imagine Mr. Market as a fellow investor who comes knocking every day, offering to buy or sell your stocks at various prices. However, Mr. Market is a rather eccentric character. He's prone to wild mood swings. Some days he's euphoric, willing to pay a high price for your stocks. Other days he's deeply depressed and offers to sell at rock-bottom prices. What Graham taught Buffett here was invaluable. The market's short-term fluctuations are like Mr. Market's whims. Most people react emotionally to these fluctuations, feeling great when stocks go up and terrible when they go down. But Buffett learned to approach the market differently. He realized that Mr. Market's mood swings didn't dictate the intrinsic value of a business. Instead, they presented opportunities to buy or sell when it was advantageous. In essence, the stock market is there to serve you, not to instruct you. You don't have a moral responsibility to follow every market movement. Instead, You patiently wait for Mr. Market to offer you a favorable deal, and then you strike. Number 3. The margin of safety. The third pillar of Graham's philosophy that profoundly influenced Buffett was the concept of the margin of safety. Imagine you're driving a truck, and you approach a bridge with a sign that says it can handle a maximum weight of 10,000 pounds. If your truck weighs 9,800 pounds, you might proceed with caution, but you wouldn't risk crossing the bridge if it were that close to its limit. Similarly, in investing, you should always leave a margin of safety. This means buying stocks when their market price is significantly below their intrinsic value. By doing so, you create a cushion that protects you from the unforeseen market turbulence or business downturns. Buffett compares this to examining a bridge and deciding not to cross it because you're uncertain about its true strength. The margin of safety is your insurance against losing your investment when things don't go as planned. Now, let me show you the essence of Buffett's investing strategy. Now that we've explored the 3 fundamental principles that shaped Warren Buffett's investing philosophy, let's delve deeper into his core principles. Number 1. Enduring competitive advantage. When Warren Buffett looks for businesses to invest in, he seeks those with enduring competitive advantages. Those advantages act as a moat around the business, protecting it from competitors. For example, Coca-Cola's strong brand and customer loyalty are testaments to such an advantage. It's not about what's earning the most money right now. It's about sustainable, long-term advantages. Number 2. Honest and competent management. Buffett insists on investing in businesses run by honest and capable individuals. He often quips that it's better to invest in a business that even an idiot can run, because eventually, one might. The quality of management is a critical factor in the success of a company. Number 3. Sensible valuation. While the quality of the business is paramount, Buffett also emphasizes the importance of buying at a sensible price. No matter how great a company is, overpaying for its stock can erode potential returns. Buffett even shares a tip. When evaluating potential investments, he prefers to analyze them without knowing their current market price. This helps him make decisions based on the business's intrinsic value rather than being swayed by market sentiment. Number 4. Think long-term. Buffett's investments are typically for the long haul. He doesn't believe in constantly trading stocks or chasing short-term gains. He's patient and willing to hold on to his investments for years or even decades, allowing them to grow and compound over time. Number 5. Size matters. As Buffett's investment capital grew, he realized that he needed to focus on larger businesses to make a meaningful impact on his portfolio. He prefers companies that can significantly impact Berkshire Hathaway's bottom line. Smaller investments would have minimal effects. In a world of fast-paced trading and market noise, Warren Buffett's timeless wisdom reminds us that successful investing is not about chasing trends, but about making informed, patient, and rational decisions. Whether you're just starting your investment journey or looking to refine your strategy, remember that the Oracle of Omaha's principles can guide you toward financial success. After all, with Warren Buffett as your mentor, you're in good company. Thank you for watching. Don't forget to like and share this video. To be more knowledgeable about financial topics, make sure to subscribe to Financial Flipside and hit the notification bell to get alerted when new videos are posted.